never listen, baby. You talk over me. Here you go again. Always me. All the things you say, none of it comes true. Met with a guy in LA. Good for you, it's all about you.
Life is an illusion, can't you see that love is everywhere? Step into the confusion, can't you hear the sound that's in the air?
It's rock and roll, it's rock and roll, it's rock and roll. It's rock and roll, it's rock and roll, it's rock and roll.
And now for something completely different.
world. It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. It's the second best day of the week, of course, Thursday. Excuse me, choked myself up. I'm so excited about Friday. Because this Friday is, the end of a long week, heading up to a short week because next week is Thanksgiving. So everybody's very excited about it. Of course, markets will be closed next week, and beginning on Monday, most of the traders are leaving, New York for the Hamptons, for the weekend, because, them and Lovey need to go down to the Hamptons for the holidays, to spend the holidays and to have their Thanksgiving break. So that means the inmates will be running the asylum next week when it comes to the financial markets. So again, lots of volatility expected next week. Again, that doesn't mean anything significant, up or down, just likely to be a lot of sloppy trading and, markets can be moving on very, very light volume. So not a lot to take from any action that happens next week in the market. So again, just however it plays out, just, kind of manage your risk accordingly, but don't overreact to a move in one direction or the other because, again, very, very light trading week coming up next week. And then immediately following that will be mutual fund distributions will start in earnest. And they've already started now, but they'll actually kind of really pick up the pace after Thanksgiving. So again, that's why whatever happens next week may not have any indication as to what the markets will be doing over the next couple. Friday, tomorrow, of course, is also options expiration. A bit of sloppiness yesterday in the markets. Markets kind of flopped around all day, kind of like a fish out of water, and didn't really finished out the market yesterday, not with a whole lot of change, down just about 12 bips, nothing major. But again, this is just, you're seeing a lot of roll in the market right now as these options are being, prepped for expiration tomorrow. So seeing a lot of movement in stock prices. Again, it's one thing to also look at this week. You may be seeing some exaggerated moves in some of your kind of favorite names simply because of options expiration and what's happening kind of behind the scenes with stocks either getting bought or sold to deal with the options contracts that are outstanding, because we do have a record number of call options out on stocks right now, and those all have to be rolled over into the next expiration month. Yesterday, NVIDIA reported excellent earnings. That stock will be up this morning, kind of helping lift the NASDAQ a bit. Again, that's one of those semiconductor stocks that have really had huge moves here as of late. And again, we're kind of seeing that, this whole idea of the metaverse and this idea of semiconductor shortages and computer demand and all this, Bitcoin mining as well. And of course, NVIDIA provides the graphics cards and the chips for a lot of the computer programming for AI, for artificial intelligence, for this metaverse type idea, as well as chips that are used in Bitcoin mining. So they've been a big beneficiary of that. AMD also, Qualcomm also on the 5G side has done very well as of late. So we continue to see semiconductors really perform well here. But again, you have to start kind of thinking about as we move into 2022, are we pulling forward a lot of the earnings growth and expectations that we will see in 2022? In other words, are we starting to see the peak of earnings growth? And if we take a look at a lot of the manufacturing indicators that we've seen as of late, of course, we've had a real surge in manufacturing activity, new orders, backlogs of orders, etc. Not surprising after you shut down the economy that you have this massive surge in activity as you restart the economy. But that whole idea of restarting the economy, we're getting fairly long in the tooth of that. The economy is restarted now. We're back. If you take a look at employment, we're back at historically low levels of full employment. Labor force participation rates have been coming up, still weaker than where we were prior to the pandemic, but they have been rising here as of late. And again, a lot of this activity in the economy, if you've been driving around Austin or Houston lately, you know exactly what I'm talking about. Traffic is back. So a lot of the things that we saw during the pandemic have now come back to more normal levels. So again, not surprising to start to see here a lot of some of the economic manufacturing data begin to peak and roll over. Now, that's important because there's a very high correlation economically between what's happening on the manufacturing side and earnings growth. So if manufacturing is indeed kind of peaking and then returning back to more normal levels, coincident with economic activity, that will also suggest this big surge in earnings recovery that we've seen since the pandemic shutdown will also revert back to more normal standards relative to the economy. So when we start talking about, the valuation of the markets, where we're currently trading 40 times earnings, very deviated from long-term means and moving averages, those type of things, there's been a lot of excuses, rationalizations that have been put together by the financial media saying, well, we can overpay for value because, earnings are rising so sharply, right? And that's fine when that's occurring, but again, what happens when you now reach this peak? And here's the interesting, narrative, and I want you to really pay attention to this. Back in 2018, 2019, early 2020, we were overpaying for value for stocks. The rationalization at that time was low interest rates support high valuations because, we use interest rates to apply a discount factor to earnings. So we can say, okay, well, low interest rates justify high valuations. We can overpay for stocks because interest rates are so low. Now, there's really no point in history where that holds true, but it's a rationalization that we use to help support the narrative why you should go put your money into risk assets. Now interest rates are rising, and the rationalization is, well, interest rates are going up, but earnings are going up, so interest rates really don't have any impact on the stock market because stock market prices are still rising. Well, that's true. Stock market prices are rising and rates are rising at the same time, but that's because there's a lot of momentum in stocks. Right now we have no fear of risk in the markets, and there's the FOMO. The fear is the fear of missing out. So we have a lot of momentum in stocks that's causing stock prices to rise, regardless of the fact that interest rates are now rising, and the interest rates do impact financial markets. I've got an article coming out tomorrow showing the whole history of interest rates as well as stock markets. And interestingly enough, the big takeaway from this article is that prior to 2000, there was a very inverse correlation between interest rates and stocks. When interest rates rose, stock prices went down. Since the Fed became active in 2000, and ever since then, from bailing out long-term capital management, going forward to bailing out Bear Stearns, the financial crisis, of course, then massive amounts of monetary policy from the Federal Reserve, interest rates and stocks have been correlated. They both rise together and fall together. The problem is that right now what a lot of media is telling you is like, well, interest rates are rising and stocks are going up, so stocks don't really care about interest rates, so stay long equity risk. That's okay for the moment. But there is a point where interest rates matter. They matter a lot because they do start to impact economic growth and earnings and the very things that support stock prices. And there's a very sudden change in investor attitude and investor sentiment at some point, and you don't know what that level is. Is it 1.5% of the 10 years, at 2% of the 10 years, at 2.5%? We don't know where that level is, but at some point in that range, the stock market will wake up to the fact that interest rates have gone up, and interest rates and stock prices will fall at the same time, and that'll be coincident with an economic contraction. So when does that occur? Who knows? But this is the thing you want to pay attention to. Be careful when listening to the financial media about there being no risk in the markets because interest rates are rising. There is. The article will be out tomorrow for you on Friday for this weekend's reading. We'll talk about that as well with Michael Leibowitz when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term long-term care. December 9th at noon. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I'm reading this headline here. Starbucks is giving away free red cups. So if you order a special coffee at Starbucks, peppermint mocha or chestnut praline latte, which is, by the way, about 900 calories, they'll give you a free red cup. And the cup is reusable, so this is a good thing, right? Right? You can reuse the cup. But aren't all cups that they give you free? I mean, it's part of what you pay for. I mean, I've never been to Starbucks to order a cup of coffee. They say, oh, by the way, when you're done, can I have the cup back? So the only difference is this one is reusable. But I just thought that was kind of funny. You know, because we're talking about inflation, right? Inflation's going up, and it was interesting listening to McDonald's. McDonald's is talking about the fact they've been able to raise prices on food, and so far customers haven't complained. Oh, they're complaining. They're just lazy and won't cook at home, so they're going to pay your higher prices for now. But there's a point where they'll say, you know what? I will cook at home because it is now cheaper to cook at the house than to be lazy and go to McDonald's. So, yeah, customers are complaining, and it's everywhere right now. So, you know, whether it's at the gas pump or whether it's at McDonald's or wherever it is, they're all blaming the president for it. But, yeah, they're complaining about your prices.
Have you seen those stickers?
Yes.
I did this.
Yes. So, yeah, they are complaining. They're just not complaining to you directly, so don't be mistaken about that. Joining me this morning to talk a little bit more about inflation and the next big shock is Michael Leibowitz, CFA. Mike, welcome to the show this morning. How are you?
Thank you. I think inflation is a huge deal, and you nailed it when you mentioned Biden's name.
Yeah. I didn't actually mention his name. I said the president, but you know, I was trying to leave names out of it. I wasn't name calling.
No, but you know, the fact of the matter is that it's been proven time and time again that the economy and inflation can dictate who's in the House and Senate and the presidency.
Sure.
And Biden knows it, right? Or his assistants know it, and they're telling Biden that, right? That if inflation is persistent, i.e. it's north of 4% a year from now, they're going to lose the House and Senate.
Right.
And it has nothing to do with politics. It just has to do with consumer confidence and mood and economics.
Right.
Right.
And we always say here on the show, look, at the end of the day, you can go up to the podium and you can talk about whatever policy you want. But at the end of the day, people vote by their pocketbook. So if you're in office and people are wealthier and happier and are doing better economically, they'll vote to keep you in office. If they're not, they're going to vote for a change because it all comes down to their pocketbook at the end of the day.
Right. And one of the conversations, we've maybe had this same conversation half a dozen times, where we say, okay, what can Biden do? Right? This isn't necessarily Biden's fault. Some of it is, some of it isn't. But what can Biden do? Biden knows there's a midterm election in about a year from now, almost exactly a year from now, right? What can he do to get inflation down? The obvious, traditional, not obvious, but the traditional way to do it is to put pressure on the Fed and get them to hike rates, get them to stop QE, and that will slow economic activity, and that will, in theory, stop inflation.
Right, but that gets you unelected because now you have rising job losses, slower economic growth, a recession, a falling stock market, and now the people that are supporting you on a donation basis, since the top 10% of people own all 90% of the stock market, they're not going to support you to rerun for president. So now you're out of office again. So hiking rates isn't really a solution. Yes, it'll certainly slow activity and lower inflation, but it has a lot of other consequences.
And the risk to it is, let's just say he decides to go down that road. Yeah. The risk is that we know that a lot of this supply-demand mismatch is coming from shortages, from the supply lines, from the boats sitting out at sea, the docks, all that kind of stuff.
Yep.
If that doesn't resolve itself in a year, you could slow down the economy and inflation could still be running 4, 5, 6, 7%.
Right.
Then you got what's called stagflation. And stagflation guarantees he'll lose the House and Senate.
Sure. Well,
right? So it's not even a risk-free policy stance from the inflation point of view.
Yeah, it's for policymakers, this is a very tough situation. Your problem on the ports is that you've got a lot of imports of goods coming in on containers, but you're short 80,000 truckers. So, you need to train truckers, get them on the road. But again, there's not, people are walking around going, well, I don't want to be a trucker. I don't want to drive cross country. I mean, we've got a labor problem. Part of the labor problem that we have in the country is a lack of skilled labor. Truck drivers have a skill, right? And we don't teach those skills. We don't encourage those skills for electricians and plumbers and construction workers and these type of truck drivers and all the other things that go on. We don't provide skill training anymore. We don't encourage skilled labor. So the problem with labor, we've had labor shortages now. Everybody acts like we're having a labor shortage now for the first time ever. No, we were having a labor. If you remember, all from 2012 after the financial crisis to 2020. We were talking about we've got a mismatch of unskilled labor. The biggest problem for manufacturers is they can't hire skilled labor. There's not enough skilled labor. We had record levels of job openings in the manufacturing area with no skilled labor to fill them. This is not new. It's just exacerbated because we've created the economic shutdown, created some additional demand on already a shortage of product and skilled labor. And now it's just out of control. And everybody's going, well, what are you going to do about it? You can't do anything about it until you start to train people, provide education, for skilled labor, get people back into the blue collar labor force, which we have been, demonizing ever since the 1980s.
Right. In 2019, there were more job openings than there were unemployed people.
Right.
2019. I'm not talking about now. Now that there's, I think it's 1.4. Right. 1.6 job openings for each unemployed, for each person that's lost a job since COVID. It's actually even, there's more of a shortage now than there was then. And so that's the other, that basically what that tells you is that workers who can fill these jobs have great leverage, right? They have incredible leverage. They can go into their boss and say, I want a raise, or I'm going to go to the store across the street and he'll pay me, right? You can go to McDonald's and make $18 an hour. Some of these McDonald's are paying $20 an hour. It's because there are just not enough workers, either with the skills like you said, or willing to do the jobs. There's a statistic they put out, the BLS puts out, is called the quits rate. And the quits rate is anyone that has left their job because they're seeking a new job. It's not to take care of a child. It's not because they want to retire. It's not for other reasons. It's because they want a new job, a different job that pays more or is closer to their house, or for some reason that benefits them. A lot of times it's just more money, right? The quits rate is 3% right now. It was traditionally low 2% of the economy. So you have an extra 1% of the workforce that's out there right now demanding more. and they will get more. In most cases, they will get more, or they will get what they want, because there's such a demand for labor right now. So what does that mean? That means means McDonald's has to pay $20 an hour instead of $15 an hour. And what does McDonald's do? They don't want to lose money. They don't even want to see their earnings grow less than they did last year. So they have to raise the price of the Big Mac and the cheeseburger and all that, right? And what starts happening is you get this wage price spiral. And a wage price spiral is, well, now the worker's saying, that's great that I make $20 an hour, but a Big Mac is $8. I can still only afford one Big Mac. I want more Big Macs. Yeah. Well, now McDonald's has to pay the worker more because he's demanding more. Then they raise the price of Big Macs. And then that's another risk for Biden. We've talked a lot, Lance, about how inflation is all about money, supply, and velocity. And it is, but there are other factors, and the shortages are a factor, and this whole psychological component is a factor where people just demand more, where people see inflation and they hoard. There was a good article about hoarding yesterday.
Yeah, so
people
this
are
is
buying more than they need because of,
but it's a good point here, and what we've got to work on, and this is the thing that we need to talk about, more in terms of policy, is that when inflation's going up, and you're right, McDonald's is going to be increasing prices because of higher wages. But there's a point to where that buckles the economy and you get an economic slowdown entirely. So, it's interesting to talk about the fact that we're all getting higher wages. That's great. But there's a very direct correlation between wage spikes and economic growth. And it's, we would psychologically think that, higher wages would lead to stronger economic growth, but it's actually the opposite. When you have spikes in wages, which you're having now, those actually precede economic recessions because of the fact that you do get an inflationary push that exceeds the wage growth itself, and it slows economic activity. So, this is one of the things that is going to be a real conundrum for individuals over the course of the next, really couple of months, because as, we start talking about, the economy and growing the markets, et cetera, the expectations going into 2022 are extremely exuberant. Goldman Sachs is expecting 5,100 on the S&P, another 10% advance. Earnings growth to continue their growth rate at the current levels that we are, reaching as much as $210 a share in earnings next year. But, with the wage pressures, with inflationary pressures, with everything else you've got going in the economy, there is going to be an impact to earnings growth and economic growth going into next year because of simply just how the market cycles work and what happens. So when we come back from the break, we're going to shift gears and talk about the next big shock, because even the Fed is now talking about the next big shock. I'm your host, Lance Roberts. We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife put up Christmas lights this weekend, so she's very excited now. But she's very upset at the same time, Brent.
Why is this?
She ordered another Christmas tree for the house. Showed up at the house, she set it up, she goes, honey, this tree's not big enough. We need another one. We'll have one on one side of the fireplace and one on the other. And I'm like, no, we're not. One tree.
The Real Investment Show podcast. Same show, your schedule.
Needless to say, I slept on the couch this weekend
at realinvestmentadvice.com.
The saga of Christmas trees in my household.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, talking about the next big shock, two Fed members have now rang the alarm bell over the broken Treasury market, which they caused, which is interesting. Two statements that were made I thought were very interesting yesterday, and we'll get more into this with Michael Leibowitz here as well. Fed Williams, New York member Williams, was patting himself on the back, saying the Fed's bazooka of QE unleashed at the onset of the pandemic, along with prompt fiscal measures enacted by Congress and emergency steps taken by the Federal Reserve and other government agencies, ultimately proved successful at restoring the functioning in the Treasury markets and other financial assets. His next statement came a little bit more dangerously close to the truth, which is one thing that is clear when examining the causes of these market disruptions is they were not primarily driven by economic forces. You shut down the economy, not you, but the government just shut down the economy. They thought that was a good idea. But rather by the failure of markets to function in ways they were expected to do in response to those particular circumstances. Well, that's been the case now for 12 years, ever since the financial crisis. Markets have not been functioning related to what the Fed thought they were supposed to, which is why we continue to do QE, because we keep doing QE to try to support economic growth and create inflation, and yet you've got no inflation up to now because of the pandemic and the shutdown, and you've had no economic growth to speak of. Barely staying above 2%, which is what's called escape velocity. That's the level at which above 2% economic growth, you actually create jobs in the economy, not just keep jobs up with the population growth. I thought this was interesting because President Loretta Mester also came out, and she said, with uncertainty related to the pandemic, many investors sought to move to cash and even liquidated their positions in U.S. Treasuries that are seen as haven assets. No, that's not correct at all. In fact, if you look at fund flows over the last several years, fund flows into U.S. Treasuries are about 20 times as high as they've been going into equities. People are shoving money into Treasuries and bonds, which is why, despite the fact that we've got a risk-on universe of stocks and you've got rising inflation, yields don't rise because people are just pouring money into Treasuries. So with that said, this is basically laying out the groundwork for what they're concerned about in terms of being the next big shock. And for that, let me go to Michael Leibowitz, who just wrote an article on this. It's on our website today. Go to realinvestmentadvice.com. And his article is up called The Next Big Shock. Mike, what do you think about these two comments?
It's literal gibberish, right? What Mester said, yields fell sharply for every yield, from really short yields to the 10 and 30-year bonds. Right? Investors reacted as they should have. There was nothing normal with investors selling stocks, with investors moving to cash. Mm-hmm. The economy was shut down. That's something we have never really seen, right? Mm-hmm. Economic growth was necessarily going to be very bad, right? We knew unemployment was going to spike. If you're an investor, shouldn't you be taking some risk off the table? Shouldn't you be hedging? Shouldn't you be moving to bonds? Mm-hmm. I'm not sure what they think is normal behavior, but I think for investors, normal behavior is to change your risk level, to hedge, to protect yourself when things are not going well. Mm-hmm. And when things are, it's not only not going well, this is something none of us have ever seen before. Right? Where they're literally, you can't go shopping, you can't do anything, you can't go to work. There were massive layoffs. I'm not sure what they're talking about. And Lance, here's what's crazy. They have permanently distorted these markets. Right? The Federal Reserve owns a quarter of all U.S. Treasuries outstanding. And if you take a look at what we call the float, so the float is how many are really outstanding. So, for instance, a pension fund owns a lot of bonds. They have no intent of selling those bonds. Mm-hmm. They're going to hold them to maturity because it matches their liabilities. So if you look at their float, they probably own half of all the available bonds outstanding. They have grossly distorted the price of bonds. So all the natural buyers and sellers are not there. So when things happen in the markets, when there are shocks, the normal buyers and sellers don't come in to help minimize some of those shocks. This is all they're doing. And now it's, use the word shock again, it's kind of shocking that they're calling this out, right? I mean, it's also weird, Lance. We've never really heard them talk about this, right? Resiliency in the Treasury market in this respect. And two of them came out yesterday, and one being the New York Fed President Williams. It's his job to quote unquote manage markets. When the Fed does QE, it's Williams and his team that goes in there and buys assets. When the Fed wants to raise interest rates or lower interest rates, it's his team that trades very short-term money market instruments to help move interest rates to where they want them. So what's he talking about? The next big shock. And you know what? If we were talking about the stock market, we may say the next big shock is the next time it drops 30% in 2 weeks like it did in March. Mm-hmm. But I think in bonds, it can mean one of two things. That yields are going to zero across the whole yield curve, or that yields are going to 4%. I don't even know when he refers to shock if he's referring to a spike up or a spike down in yields. And I actually think that they're equally concerned about yields dropping like a rock. And part of that is because there's, believe it or not, despite these massive deficits, there's not a lot of supply of Treasury notes and bonds outstanding, as crazy as that sounds. And we see that every day. The Fed does their repo program, and they're lending now $1.5 trillion of securities every single day. And so you may ask, well, why? Who wants to buy all these bonds? And some of it is just people need bonds. People are using it to hedge. We own some bonds right now as they're hedging us. We're not in it for the 1.5% coupon, but we are in it because if yields go lower, we can make 5, 10, 15% on our bond positions with relatively less risk than stocks. But the bigger problem is that, and we've pointed this out numerous times, leverage is immense in all the markets, right? And for leverage, you have to borrow money. You also have to put up collateral. In almost all cases, collateral is treasuries, right? Treasury bills, sometimes treasury notes. So they are taking this collateral, these bonds out of the market, essentially calling them collateral, giving them to the bank that's lending them the money, and taking that supply out of the market. So, when we talk about resiliency of the market or the next big shock, it's hard to know whether they're talking about inflation scaring the market, bringing it up much higher in yield, which would destroy the economy, or dropping yields to near zero, which has other implications for the economy, for the dollar, for the global economy. So it's like you said, Lance, I just think it's kind of shocking that they both said similar statements on the same day.
Yeah, and normally, we talk about the Fed, kind of releasing these, kind of messages or these trial balloons into the markets to see how the markets react. And, is this just a trial balloon, or is the Fed actually, sending out these messages to try to warn the market about potentially a bigger problem that's occurring? And it's interesting when they talk about the treasury markets and they talk about what's going on. They're responsible for all of this, and I it's they never look back at themselves and go, maybe it's our actions that are causing this. It's never their problem. It's always everybody else's problem, and they're just there to try to solve it. But if we go, and again, in our article that we've got coming out tomorrow, we've got, we take a look at the history of the financial markets and interest rates and what goes on with the markets itself. And going back through history, back to 1980, after the Fed became active and doing their monetary policies to a great degree after Paul Volcker, every financial crisis, whether it was the Orange County the Orange County crisis, the savings and loan crisis, long-term capital management, the dot-com crisis, there's a direct correlation between Fed actions, what they're doing with interest rates and monetary policy relative to every one of these crises. So they create the booms, and it's never their fault, and they create the bust, and it's never their fault. It's always somebody else's.
Right. And look, we can look at valuations. Valuations are now higher than at the same or higher levels in 1999 and well beyond 1929. That is setting up an incredibly poor risk outlook, right? That's not a resilient market, right? If you go back to March of 2020, the market fell 30%. That's what the market should have done with the economy shut down. A resilient market wouldn't have jumped up 50, 60% from there in a matter of, less than a year. When the economy shut down, when everything is slowing, the reason the market shot up so much is because the Fed came to their rescue, right? And they pumped in a ton of money and liquidity into the markets. And here we are today with what looks like a nice, stable market that goes up every day. Everyone's happy. It couldn't be more unstable right now. It's lacking resilience. As much as, it's kind of funny to say, but the bounce off the lows in March was not resilience. That's not what the Federal Reserve should really want to see. They should want to see a market that's properly evaluating the economy, earnings, and stocks, and pricing accordingly. And I think over time they would have realized that the pandemic would be relatively short-lived, the effect on the economy at least. I mean, it's still affecting us. And over time it would grind higher.
Yeah.
But to valuations that make sense.
Well, and like we said earlier, with interest rates going up, the one narrative that's been supporting these high valuations is that low interest rates support high valuations. Right. Unfortunately, you can't have it both ways. With interest rates going up, you can't say interest rates support high valuation. Higher rates support higher valuations. It can't be both, and so that's going to be one of the bigger problems potentially coming up for the markets. When we come back from the break, I want to switch gears, talk about inflation here for a second, and more importantly, retail sales out earlier this week. Just a really good retail sales report, but really, was it as good as it appeared? And why is it that it seems like consumers are still spending despite these rising inflationary pressures? Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care, December 9th at noon. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number. It's 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, welcome back to the show this morning. President Biden is asking the head of the Federal Trade Commission to look into whether oil companies are illegally increasing prices as consumers face high costs at the pump. Okay, I know that President Biden's been around for about 80 years. I'm not sure exactly how old he is, but he's been around for a while. And oil prices are not dictated. You know, there's not a guy sitting at the head of ExxonMobil going, "Yeah, I think I'm going to charge $80 a barrel for oil today. So that's our price for a barrel of oil." No, that's not how it works. You know, the price of oil per barrel is set by NYMEX, which is the New York Mercantile Exchange, and that is traders on Wall Street that are speculating on the future price of oil. And they're driving the prices of oil contracts up and down, and that drives up the price of oil or down the price of oil, depending on what expectations are for delivery, et cetera, so forth. And if that wasn't the case, right? If you don't believe that, then oil companies would not have entire trading desks inside their companies to hedge against oil prices in the future. And they're buying futures contracts to hedge against their delivery of oil price in the future. See, there's two different types of traders on the exchange that are trading in commodity contracts. And I write a report on once a quarter on the commitment of traders contracts. There are the speculators in the markets, that's Wall Street, and they're the largest traders by far of contracts on commodity prices, from everything from oil to lumber to copper to pork bellies. And then there's the non-commercial hedgers. These are the guys that are actually, have product to deliver. So if I'm going to deliver a bushel of wheat, and I plant my wheat in my field, it's going to take me 3 months to grow that wheat, and another month to bundle it and deliver it, whatever the time. I'm not a farmer, so whatever the time frame is, don't email me and tell me how long it takes to grow wheat. Okay, just follow me through here on the logic. I'm trying to, if the price of wheat today is $4 a bushel, but I think there's going to be a bumper crop this year, and because of a lot of supply, that wheat prices would fall to $3, I can go out into the market and guarantee myself delivery at $4 by buying contracts. That's why farmers and commodity producers of all types hedge their contracts. Now, why am I telling you this? There's no illegal activity going on pricing from oil companies. It has everything to do with what's happening on Wall Street. That's what's driving up prices. And the expectation is because of inflation, a shortage of supplies, demand, all these type of things, right? It's going to require, there's a lack of supply of oil, and there's too much demand in the economy for delivery of goods and products and services. So that demand supply imbalance is going to cause prices to go higher, right? So, but the question then becomes, this inflationary pressure is feeding through to consumers. And consumers having to pay higher prices. We started out the show talking about McDonald's and the cost of stuff at McDonald's going up. And this is the interesting thing. So far, they've been able to pass it on. I'm going to read to you something here real quick because there was an article out on Yahoo Finance this morning talking about inflation is not a problem because consumers are able to take it in stride. This leads us up to the $64,000 question. Why do consumers appear so comfortable with higher prices? Apparently, the author has not been on Twitter, Facebook, TikTok, or anywhere else at this moment on social media talking about inflationary pressures and why consumers are upset about it. One answer is they're clearly earning more. Okay, data from the Economic Policy Institute shows a V-shaped wage recovery that began in April 2021 has translated into a 5% year-over-year jump in hourly earnings. Okay, hourly earnings are up 5% year-over-year. What's inflation right now? 6.2. Wages have gone up 5. Inflation has gone up 6.2. What's happening here? Right? I'm still having to pay more for stuff that I'm actually earning. But that's not all. Yet the data suggests consumers are doing what they've always done. They've just spent more. Why are they spending more? Where's all the money coming from? Well, higher prices. You know what we have going on right now? Consumers at this moment are doing more than ever equity extractions from their mortgages. Last time we saw that to this degree was back in 2007. They're also turning back to credit card debt to make ends meet. This is sustainable for a while. All this money availability is sustainable for a while until it's not. Michael Leibowitz,
I want to make
your comments on this. What?
I want to make a U-turn and go back to oil.
Okay.
Because I think that's what we've had a few conversations about this, and what's really concerning is put yourself in the shoes of an oil producer, right? And you can pull oil out of the ground for say $60 a barrel. It's different for every producer, but let's just say 60, right? Oil right now is in the upper 70s, low 80s, and all of a sudden the president is screaming bloody murder, and he's doing whatever he can. He's asking foreign governments to release oil from reserves. He wants to release oil from our reserves because 80 is too much, right? Because he wants to win an election in a year, and we can't pay 80. So think about what that means for the producer. The producer is saying, okay, I can pull it out of the ground at 60, but the most I can ever make on it is 75 or 80 because the government's going to do whatever they can to keep the price below 75 or 80. Now, on the flip side, back in March and April of last year, the price of oil went negative. Where was the government, right? So there are the incentives the government puts out for oil producers is warped, right? In theory, what we should be seeing are oil producers saying, let's put more rigs out there, let's drill more, let's do more, because oil is 80 and it's probably going to keep going higher. But they're not doing that. They're not producing more oil, which would solve the price problem.
Well, why would I? If I'm an oil producer right now and I've got the government coming after me at every corner to shut me down because of, climate change and we need to transition into, electric vehicles and, there's all kinds of, removing incentives and et cetera for the production of oil. And what people forget is that the price of oil production goes up with the price of oil. Because as oil goes up, the cost of me to extract it from the ground goes up because I've got to pay higher wages, higher costs goes up, piping, drilling, everything else increases in price along with the price of oil, just like everything else. Then I've got to pay more. So what I was able to extract at 40 is now 50. What I was able to extract at 50 is now 60. And the spread between what companies are making on a barrel of oil and what it costs them to produce continues to get squeezed just even as prices go up. So you're right. I mean, it's a warped imbalance between what the government wants. They don't care when oil prices go negative and gasoline is $1.35 at the pump. They care a lot at $3. But where was the help for the oil companies when they needed help and they were going out of business?
Right, right. So the incentives are warped, and this is true everywhere. They're warping markets, right? We talk about this in the stock market and bond market all the time. They warp markets through their participation, whether it's direct buying, direct selling, whatever they're doing. They don't let free markets be free markets. And the result of that is that the supply and demand become warped. They have problems. And in this case, there's no incentive to produce more oil. If they produce more oil, the supply would meet the demand and prices would stabilize or go down. And that may take 6 months or 9 months or a year, but now we're at the point where doesn't make sense for producers to make a long 5-10 year bet on oil prices when you got a president trying to push them down, and then you got these policies that pretty much are calling for the demise of oil in 10-20 years.
Well, look,
right?
and
How can you expect them to make these investments?
Yeah, no, you've got activist investors that are now, Dan Loeb with Royal Dutch Shell trying to split the company into two parts and liquidate the oil production side. You've got Engine One on the board of ExxonMobil trying to push them more into green energy production and away from oil production. It sounds great. What nobody's thinking of is that in 10 years down the road, when you go to this whole idea of having, electric vehicles everywhere and suppressing the price of oil, the cost of everything is going to be dramatically higher because oil is in petroleum products. We always think about, oil in terms of gasoline, right? We don't think about in terms of the petroleum products used in virtually everything. The cost of flying a plane, the cost of building a plane, a car, houses, clothing, all that stuff. Those costs are going to be dramatically higher the more that you press down petroleum. So, it's the thought of being, climate friendly is excellent. We talked about this. So I got no problem with it, but we're not thinking through the unintended consequences of these actions as we go forward. And, here's an interesting thing. I was listening to Joe Biden this morning, a clip from him yesterday talking about he was in, I think, Detroit yesterday. Or Michigan, talking about having 500,000, electric chargers all across the country, so people can charge their electric vehicles as they're driving across the country. Okay, so I'm driving across the country. I got to stop for an hour. I got to recharge my car to get to where I want to go. That's one thing. But the other thing is, how are you going to start collecting taxes? One thing that you get out of gasoline is when you fill up a tank of gasoline, you're paying taxes that support road construction, road development, all those types of things in the economy. Eventually you're going to start charging electric vehicles, for the cost of taxes. And then, of course, who's going to pay for the electricity that they're using on these superchargers, right? So, if the electricity cost goes up dramatically, which it will, the cost of driving an electric vehicle is going to become very difficult down the road also. Right now It seems to be free, but it's not.
Right. They're not focused on the gap. Yeah. Right. At some point, we will have different forms of energy, whether that's 2030 or 2050. Who knows what it is, right? Our dependency on carbon type energy will go down, but we're not managing the next 20 years. How are we going to get there? How are we going to incentivize the oil companies to keep doing what they're doing, knowing that they have to change in the future? Yeah. And that's the big policy mistake they're making, is the gap between now and then.
It's always the mistake that they make. They're always trying to solve a problem that is now, and they don't plan for the unintended consequences that will come. Nobody's sitting up there thinking about, okay, if we do this, what is going to be B, C, and D that happens from this action? They never think about that. And then when that crisis comes up, we're now solving that crisis. And this is the problem with government. We're always a reactionary government rather than a proactive government, which is why we're running, $3 trillion in debt, or $3 trillion deficit, because we're always reacting to the crises that we cause. That wraps up the show for the day. We'll be back tomorrow with Financial Fitness Friday with Richard Rosso and Danny Ratliff. Of course, tune in then. Make sure you get by our website today. Michael's new article is up called The Next Big Shock. It's on the website now, realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow. See you then.